Hello and welcome to another segment of Western Wisconsin Journal. I'm Jamie Johnson, the legal and government correspondent, and today I have a guest from the CPA firm of Clifton Larson Allen. I have Sonia Jansma. Sonia, welcome to the show.
Thank you.
I know Sonia from Rotary and then also professionally because often law offices and accounting firms have mutual clients and intersecting businesses. Well, the purpose of our visit today and what we want to inform the viewers is about the Taxpayer Relief Act of 2012, also known as the Fiscal Cliff legislation. Is that right?
Yes.
Now, what we're not going to talk about is the policy necessarily that went on for the 4 to 6 months that everyone knew the fiscal cliff was coming. And for fiscal cliff terms, that was both revenue and spending changes in the federal government that were going to automatically kick in. And there was months and months of negotiation, more just with the media. And then after the election, once the voters had decided a little bit on policy, there still was a lot of wrangling, and they came close within, I think, a couple $100 billion of getting a bigger bargain done, and then instead decided to separate the tax from, or revenue side, if you will, from the spending side. And so now they're going to be dealing with the spending legislation in the coming couple months, at least up to when our federal debt ceiling has to be addressed. But what I wanted to talk about was the tax side, because this is what affects people, I guess. Certainly the spending side of the federal government will, but that's still very much in the policy stages, and people can contact their congressman and we can have other guests on, debate what's good or bad. But in the end, we have a piece of legislation that was written and passed in that time period around Christmas. Is that right?
New Year's.
New Year's, actually.
It was signed on January 2nd.
And so when they separated out the tax side, they said this is what we're going to do for revenue. And boiled down to a 20-second soundbite during the election, President Obama was rather firm in saying that he intended to keep the tax cuts that had been enacted originally under President Bush back in 2001 for those people making under $250,000 as a married couple. Is that correct?
Right.
And then there was, in that course of that discussion and negotiation, Speaker Boehner tried to get some legislation that maybe would have the cutoff at $1 million. Ultimately, what we have is $400,000 for individuals and $450,000 for married couples. Is that right?
Correct.
So let's get into, the official name is the American Taxpayer Relief Act of 2012. And Sonia, why was it, I don't know, why is it enabled, or why is it called the Relief Act of 2012 when really they were just continuing previous cuts?
Well, the thought process behind that would be the fact that they extended the lower tax rates. They maintained the 10% tax rate rather than increasing that to 15%. They kept them across the board pretty much the same for everyone. They did add a 39.6% bracket for the higher income taxpayers.
Okay.
So there was some relief there, and then other credits and some AMT changes.
So basically that original, the Bush tax cuts as they were called, they were supposed to actually end at the end of 2010, and then that got extended through negotiation for another 2 years, considering that the economy wasn't real strong, and the thought was not to try to send us back into recession, and so those were extended to the end of 2012. But they were actually made permanent, is that correct? Now these new tax brackets?
Yes.
Okay.
Several of the changes they made were permanent. There are a few that have been just extended for 2 years or 5 years.
I guess as permanent as tax legislation can be, right?
Until the next person gets into office, yes.
Right. All right, so let's talk about, I guess, the tax rates. And I think we have a PowerPoint that we'll be putting up. The prior rates ranged from 10% to 35%, and it depended on a strata of income. Is that correct?
Right.
And under a certain amount, if you were below what your exemptions and standard deduction would be, there'd be 0% in effect, correct?
Right.
So like for college kids, I have a daughter who's just into the labor market, and if she made less than $5,000 or $6,000, it's likely between the exemption and the deduction she's not going to have to pay, or at least she'll get a refund back. Is that right?
Right. Yeah, a dependent wouldn't get their own exemption, but they would still get a standard deduction based on the wages, and they can reduce their income to zero, but not below zero.
Okay. So what we're going to try and do, in as exciting a manner as we can with tax law, and I'm not a tax attorney, I'll have that disclaimer, and we should also have a disclaimer that any questions that people have that might pop into their head, they should not make any assumptions from what we're going to discuss. We're discussing generalities here rather than individual circumstances. Is that correct?
Yes. Yeah, every individual tax situation is different, and it's difficult to generalize without looking at all of the facts.
Okay. But if we look at these brackets and adding that 39.6, in a sense, for those people that make, say, $449,000 as a married couple or less, are they seeing any change at all in their taxes?
They should see some change based on the alternative minimum tax changes.
Okay.
Those are other things that would affect their tax that maybe aren't reflected in the tax brackets, and the tax brackets are adjusted for inflation each year.
And I guess we should say right off the bat, in effect, everyone's taxes are being changed by the 2012 American Taxpayer Relief Act, because the FICA tax is going up from its temporary reduction from 4.2% to 6.2%. And that's in effect a 2% raise on all incomes up to a certain level, because there's a ceiling on the FICA tax.
Right.
What is that ceiling again? Do you know what it will be for 2012?
The ceiling, it's around 110,000. I don't know the exact number.
I think it was, the last year we filed was for 2011. I think it was 106,800, and that gets adjusted annually. And so if you make over 110,000, you will not see any additional tax taken out, but everyone's seeing an extra 2% comparing 2012 to 2013.
Right, in the Social Security tax.
On the Social Security side.
Right.
But let's talk just about the income tax then. Assuming that you have these, make less than the 400,000 as an individual or 450 as a couple, then your income tax itself, the rate, is not going to change.
Right.
Okay. The strata of income for each of those brackets, we don't have a PowerPoint for, but that's because it changes every year. Is that correct?
Right.
Okay.
Yes, and that information is all available on the IRS website.
Okay.
They update the publication annually.
But those will be adjusted for inflation, is that correct?
Yes.
I know in the past, in previous years, one way of raising people's taxes without really actually having to pass a law was to not adjust it for inflation. As people made more money, then they creeped into those other brackets. But now they're adjusted, so is it linked somehow to the consumer price index or something along those lines? Okay. So the capital gains tax rate. I know capital gains, we're talking about dividends, it's basically income not from wages. Is that correct?
Right. It would be considered passive income.
Okay.
Or investment.
So on passive income, that prior to this change being in effect, it was taxed at what amount?
Well, it depended on what your income level was.
Okay.
Are you thinking before the 2001 Act?
Before the 2012 Act.
Before the 2012 Act.
Yes.
The top capital gain tax rate and dividend rate was 15%.
Okay. And it was actually 0% if you were below certain levels on your ordinary income.
Right. If your income was in the 15% bracket or below, the income tax rate on the capital gain and dividend was 0.
Okay. So again, talking about those brackets, it's 10%, 15%, 25, 28, 33, and now the new one is
and the 35 is still there.
Okay.
And the addition 35. Of the 39.6.
Okay. So those were going to move up without this legislation because of the expiration of the Bush tax cuts, and would in effect go back to what the rates were before. So we don't have to worry about that. But with the capital gains, if you are making, or your income from wages or active income, if you will, is 25% rate or higher, which I believe taxable income-wise, that's 72,500.
Yes.
And that would be excluding your exemption. I mean, you could add your exemption to that and your deductions and so forth.
The standard
And so,
deduction.
depending on what your deductions are, itemized deductions, and how many exemptions you have, that income could be an amount more than 72.5 and still be in that 15% tax bracket.
Sure, you can strategically bring your income down by contributing to an IRA if you're eligible. You could put money into an HSA if you're eligible. If you have a student in college, you could take a tuition and fees deduction rather than the credit if you were going to save yourself more money by reducing your adjusted gross income to pay a lower rate.
Okay.
So there's some strategies that you can use when you're doing your tax return.
One thing before we leave the capital gains discussion, and that is that there's an actual surcharge or surtax, if you will, of 3.8% for capital gains starting in 2013, but that's only for people that make, again, over that 400 or 450,000, depending if they're single or married.
Yes, that's the new Medicare surtax that was part of the healthcare legislation.
Okay.
So that essentially makes the higher incomers, they have a 23.8% tax rate on their capital gain rather than just 20%.
Capital gain or dividends.
Or dividends, right.
All right, so this passive income that you might get if you invest in something will get taxed at 0% if your ordinary income's under, ordinary taxable income is under 72.5, and then if it's over that, but less than this 400,000, 450,000, it's going to be at 20%. But if you are fortunate enough to make over 450,000 as a couple, then you're going to see actually closer to a 24% tax on your passive income.
Right.
Okay. Now, this is something that has been talked about for many years, is the marriage penalty relief portion of taxes. And I think that started probably under Clinton when the marriage penalty was trying to get addressed. And I don't know, this is again something that is making that level the playing field, so to speak, between married folks and single folks. Explain that a little bit. How does it level the playing field?
Well, the biggest penalty for married couples is that the standard deduction for the couple was not double the standard deduction for a single taxpayer, so they had less deductions. And then the tax brackets also for a married couple was not double the income level of the tax rates for a single taxpayer. So not only did they have a higher taxable income, they also paid higher rates. And what this act did was make the permanent changes, making the standard deduction for married taxpayers equal to double that of single taxpayers, as well as the tax rates equal to double those of single taxpayers. So it was a good win for the married couples on this act. It had been something that was put in play, but it was temporary, set to expire, and now they've made it permanent.
Okay. And again, excuse me, as you said, this becomes more of a permanent thing. What is that amount? The standard deduction, do you know what that amount, or that varies by each year as well?
It does. It's adjusted for inflation. For example, a single taxpayer would have a standard deduction of $5,800, and then a married couple would be exactly double that, where in the past it used to not quite be double.
Okay. All right. So just using that example of the 5,800, so that would be 11,600 for a couple, but that's the standard deduction as opposed to itemized deductions. If you itemize, then this doesn't apply to
Right.
you. Okay. Now, let's get into the credits a little bit. And one that is very near and dear to me and my wife right now was the American Opportunity Tax Credit, because we have college-age kids. And this started in, I think, '09 was the initial, and it was set to expire as well at the end of 2012. Is that right?
Right. This was really an expansion on the HOPE credit
Okay.
that had started
And
earlier.
did that go back to Clinton era then, the HOPE credit?
Yes.
And so trying to give middle-class families particularly those who are trying to get kids through college with college tuition raising way faster than the rate of inflation, trying to give some tax relief to those families. And so it's a little myriad of deductions and credits, and so it can be a little bit confusing, but people have choices. They can do the American Opportunity Tax Credit, or they can just take a straight standard deduction for tuition as well, correct?
Right, yes.
But depending on their tax bracket, it could have a much better impact taking one over the other.
Right, it makes sense whenever you're filing your tax return to calculate both deductions, or the deduction or the credit, to see which gives you the best tax benefit.
And let's just talk, just spend a few minutes, this one that I'm at least familiar with and can talk about a little bit, this American Opportunity Tax Credit, because I don't know how many people are aware of it, and that the fact that it's been out there for 3 or 4 years now. But families can take, and this is per child, correct?
Right.
So basically, it's a tax credit. So instead of a deduction off of your taxable income, this, or adjusted gross income to get to the taxable income number, you can actually take dollar for dollar what you spend for certain type of qualified education expenses, take that straight off your tax liability. Is that correct?
Correct.
Up to the first $2,000 per student.
Right.
But only for the first 4 years of their college education.
Yes. So it makes sense sometimes if you only pay for the one semester when your student is a freshman, to use that one semester as the lifetime learning credit to save the American Opportunity Tax Credit for the next 4 years that are possibly going to have 2 semesters. So you would have more tuition paid and would maybe qualify for a higher credit.
Okay.
So there is some strategy.
I think that we, yeah, I think we didn't do that in our family. We used it the first time it was available. But
Sure.
For instance, my oldest daughter, who was beyond 4 years to get her bachelor degree, we could not use it for her because she was outside of those first 4 years of school. And when it comes to this choice, you also cannot double count, for instance, if you had a 529 plan, which is a savings plan for families who want to earn income on an investment tax-free and can put towards their education. A 529 deduction or withdrawal, if you will, cannot be double counted and used as the American Opportunity Credit, correct?
Right, because typically the 529 money, it's like prepaid tuition plan, sometimes is what they're called, and then you put money in there and it grows tax-free, and then you can use it tax-free then to pay for your education.
But you could use a combination of them, but you better consult with your accountant, correct?
Sure, you should track those dollars, and you also need to take into consideration any scholarships or non-taxable grants also.
Okay, so it's the first $2,000 of qualified education expenses that can be used for this tax credit. So if your tax bill, for instance, was $12,000 and you paid $2,000, it would be then $10,000. And if you had 2 students at that rate, it would reduce your taxes to $8,000.
Sure, and there's also the 20% of the next level of the tuition. So the credit would be capped at $2,500 per student.
Okay, so if you had up to $4,000 in expense that you were using that didn't come from scholarships or these 529 plans, it's basically 25%, right, of what you pay over the first $2,000 can be added to that first $2,000 of credit for a max credit of $2,500.
Correct.
Okay. Enough, I think, on the American Opportunity Credit. But again, it's actually, is that refundable, the American Opportunity?
Portion of it is, yes.
Okay.
Up to $1,000.
Okay. And then let's talk about the child tax credits, because this is something that, of course, with our kids being 19 or over, in fact, it's 18 or over, right? They have to be under 17?
Under 17.
Okay.
They're under 17, so when they turn 17, you no longer qualify.
And yes, so we haven't taken that for quite a while now, but the child tax credit has income caps as well.
Right. Yes, and it also has a portion of it that can be refundable. So if you, say, offset all of your income tax liability with your credits, and there's a specific order that you apply the credits to your tax liability, and if you get to the point where you no longer have a liability and you still have some unused child tax credits, they will flow down to the refundable side of your tax return. and you could actually get a check for those.
Difference between a child tax credit and an earned income tax credit, what's the primary difference?
Earnings,
Okay.
basically. You have to earn less, you have to be a lower income family to qualify for the earned income credit.
Somebody in that top tax bracket, the newly created 39.6, is not going to qualify for any of these tax credits we've talked about, correct?
No, no. And the child tax credit also phases out at $120,000.
That's the child tax credit.
Right.
The earned income tax credit's even way lower than that.
Even lower, yes.
And why does it say, it says for taxpayers with 3 or more children?
Right, they've increased it where the tax credit used to be based on 1 child or 2 children, and then they added another amount if you had 3 or more. So it used to be 2 or more, and then they increased the refund, but this was only extended for 2 years.
Okay. So again, we're not going to get into the politics of why that is, but it's just interesting that we already have extra money for larger families in the exemptions. For every child dependent, they get an extra exemption and increases the amount of income that doesn't get taxed. But then if they make a certain amount of money, they also get an extra earned income credit based on having more children. Is that right?
Right.
Okay. But these are important things to know depending on what your family size is and so forth, correct?
Yes.
Well, let's just briefly touch on then these other tax breaks that were extended. And most of these, it looks like, were only extended into 2013, not made permanent, correct?
Right.
So what are those that were just extended into 2013? There's the educator expense deduction.
Yes, that's a big one. A lot of teachers have taken the $250 above the line deduction for classroom supplies. It doesn't qualify for people that have homeschool classes. You know, if they're teaching their kids, you don't qualify. It has to be in a school.
So it could be a private school or a public school or a charter school.
Right, right.
But, and these are teachers that may dip into their own pocket to give pencils and erasers to their own children that don't have them in the class.
Or books, reading books and things. There's always expenses. Both of my parents are retired teachers, and I know they were always buying things to put up bulletin boards and other materials, art materials and supplies, because the school budgets are limited, and sometimes it's difficult to request certain supplies for your classroom because you have to submit a request, it has to get approved, and then you have to wait for it to be ordered, and sometimes the timing of that makes it difficult to plan.
Not very practical.
Right, so the teachers just go out and spend, you know, the 10, 15 bucks and buy the supplies they need, and what this is allowing them to take it as an above the line deduction on their tax
up
return.
to $250.
$250, right.
So again, that's a deduction off of taxable income. It's not coming straight off their tax liability.
Right.
Okay. Exclusion for discharge of qualified principal residence indebtedness. That sounds like a long term for is basically your mortgage on your residence, correct?
Right, right.
It would not apply to second homes or cabins or anything like that?
Right. It's principal residence, so it would be your primary home. And what this does is make it, if you have lost your home in foreclosure, then you do not have to pay tax on any tax benefit that you've received. If you have a gain then on the sale, because a lot of homes are valued less than what they were purchased for, so there's a loss there to you, but then also the forgiveness of that debt is not taxable. And that was extended for 2 more years, retroactively to beginning of 12 and then through 2013.
Mortgage interest premiums are still deductible now on
Yes.
qualified residences?
Yes, yes, which is a nice deduction for those income taxpayers that did not have a 20% down payment on their house and were required to take out the private mortgage insurance policy that is very expensive, can be $100 a month. It made it so it wasn't such a painful thing to pay when you can deduct it on your Schedule A.
And so this is, just to be clear, this is mortgage insurance that your bank charges automatically in some cases, or if you have the 20%, they say, you know, it's kind of up to you, but
Right.
So it doesn't apply to everyone.
Right, yeah.
And it does not apply to title insurance. That's something
No.
different than mortgage insurance.
Right.
Okay. Here's a big one, especially for Wisconsin and Minnesota. The state income tax or state sales tax. You can take either one of those off of your, on your Schedule B, Schedule A, sorry, itemized deductions, but you can't take both.
Right, right. Okay. It was originally enacted for the states that don't have a state income tax, but do have a higher state sales tax, like Texas or Washington, where taxpayers weren't getting a deduction, but they're paying much higher sales tax rates. And it also benefits a lot of taxpayers in Wisconsin, even though we have an income tax. There's some retired taxpayers who don't pay state income tax, but do pay sales tax, so they do still qualify for a deduction on their Schedule A for the sales taxes paid.
And maybe this goes without saying, but I just want to remind our viewers that this American Taxpayer Relief Act, this is all we're talking about federal taxes, not state tax. We'd have to do a separate show on that. Okay. Then the above the line qualified tuition, just like your educator expense deduction, those tuition and related expenses, if you don't take the American Opportunity Credit.
Yeah, if you don't qualify for that, if your income's too high, for example, then you're left only with the option to take the tuition and fees deduction.
Okay. Here's one that I know for those people that are 70 and a half or older, and the IRA, if they want to be able to make a charitable deduction rather than take the distribution and then end up getting taxed and then turn around and giving it to the church. This was an idea of being able to give that money directly to a charitable organization like a church that qualifies. That got extended through 2013.
Yes, and they've done some really unusual things with this act. They made since it wasn't in place for 2012, they're allowing taxpayers who took distributions to go back and basically recharacterize those and say, well, then this distribution I took should go directly to the charity, and then they don't have to pay income tax for it. They don't get to take the deduction for that, but then they also don't have to report the income. And they have until the end of January to do that. And they can also still, through the end of January, take a distribution now, send it directly to your charitable organization, and take a deduction for 2012.
Oh,
They're
wow.
still allowing a little retroactive time
without
because
this
of this
change. Without this change, there would not have been that advantage.
Right. It expired at the end of 2011.
And this is similar, isn't it, to what they did 3 or 4 years ago, Hurricane Katrina, when there was a year end, and they were saying if you're going to give to these organizations, we'll give you a special extra 30 days or so, 31 days to give and still apply it to the 2012 tax year. And that's what they're doing here. But you don't have to, it doesn't have to be for hurricane relief or even Superstorm Sandy relief or anything.
Yep. Okay. Any charity.
Final couple that non-business energy property tax credit for energy efficient homes. Tell us about that.
Well, if you installed new windows or exterior doors to make your home more energy efficient, then you qualify for a tax credit based on the cost of the materials. And that credit did expire at the end of 2011. They made the change retroactive back to the beginning of 2012 and extended it through 2013. So if you made changes to your house during 2012 with any energy efficient properties, if you put in skylights or solar panels or things like that on your home, it's non-business, so it's personal use items, then you can qualify for this credit up to $500 or $200 if it's for skylights or windows.
Okay. So it says lifetime credit is still limited to $500.
Right.
So I think we remodeled our house and added a new storm door, and our contractor said this qualifies as energy efficient door, and so whether that was $244 or something, and so I'd have to count that from 2010 if I wanted.
Right.
If we did another door in 2012, then it could be up to $256 then.
Right. Yeah. You would still, once you hit that lifetime cap, then you no longer get to take the credit.
Okay. And then finally, credit for energy efficient appliances, and I know that in 2010 or 2009 that was really a big deal because people were well, in fact, they even had the cash for clunkers, so people were not only just
Right.
changing out appliances, but also the vehicles. So this, just like those other retroactive changes, they're making retroactive changes then for this energy efficient appliance. If you bought a refrigerator or similar appliance that saves energy, you can get a credit, and that got extended for through the end of 2030.
Right.
Okay, great. Now, another item that, in fact, we've had guests on this show. I had my sister-in-law. They have a tax preparation business down La Crosse, and had her on. We were talking about the AMT and how they needed to, and it was that annual chase to get that patch, they called it.
Yeah.
Tell us what changed now. Now we won't have that. The patch is permanent. Is that correct?
Right.
Before we talk about the permanent patch, better explain alternative minimum tax, because that goes back 40 years, and there may be a lot of people that are very familiar with it because they run into it every year. But what is alternative minimum tax?
Well, in 1969, Congress wrote the alternative minimum tax as a way to ensure taxpayers that were getting deductions but were in a higher bracket still paid a minimum amount of tax. So it's really not a good thing when taxpayers, when I talk to clients and I tell them, oh, you have alternative minimum tax this year, they think, oh, that sounds good because the minimum. But really it's the IRS taking away deductions that you would normally get, like your state sales tax or state income tax deductions on Schedule A. Those go away, and other tax preference items, and then your income.
Like mortgage and interest?
Mortgage interest is still deductible.
Okay.
But it's depreciation and mostly business type deductions, because there's an alternative minimum tax depreciation schedule, which is slower pace than normal. So those things would all get added back to your income, and then a new tax would be calculated at a different rate than the ordinary income tax rates or alternative minimum tax rates. And whichever one of those taxes came in higher was the one that you paid.
Okay. But you could actually be thinking that you're getting a more generous or lower tax liability, and then get hit with this AMT. And it was at certain levels, 86,000 or 72,000 of taxable income, and then that would trigger this, and then you'd have to see whether or not you could take all your deductions and so forth.
Right, yeah.
And so now that's gone, and now it's permanently set at a level that will get adjusted for inflation. Instead of everyone's incomes creeping into this new AMT, it's going to adjust.
When they originally wrote the tax, they failed to include a provision in there for it to be adjusted for inflation annually. So back in 1969, incomes were different than they are today. And so somebody making the same then as now would be considered a low income taxpayer, but back then they would have had alternative minimum tax, and now it just kind of levels the playing field by making that what it was originally drafted for was for a higher income.
I hope they set it at a higher amount too, the AMT amount, than what it was. But 1960, it's only took them 43 years then to finally get that adjusted. But you're right, somebody making $60,000 a year back in 1969 was making a lot of money.
Right.
Right.
Yep. Yeah, and a new change, in addition to the annual inflation adjustment, is they have allowed taxpayers with personal tax credits to apply those towards their AMT, like the American Opportunity Credit and things like that. That used to be, if you had alternative minimum tax, you were precluded from taking those credits.
Oh, okay. So all those credits we mentioned closer to the beginning of the show, those get to still be taken even if you happen to fall into this AMT.
Right.
Oh,
so that it's a good thing. Yeah,
again, they
there were
should
some
be
good
consulting
changes.
with their tax preparer or accountant.
Yes. Yes.
Okay. Well, you've mentioned the favorable changes. Let's talk about the unfavorable ones. Who was not a winner, if you will, with the extension of the Taxpayer Relief Act of 2012?
Higher income taxpayers are definitely going to see an increase in their tax. Everybody is getting hit, as we mentioned at the beginning, with a increased 2% rate to their Social Security tax. So that was one big change.
On their first $106,000 or $110,000 of income, roughly. Yes.
Mm-hmm.
Okay.
So that's really the biggest effect there for bad things.
Well, this higher income threshold, now there's a couple different thresholds that were discussed. For instance, we've already talked about the rates and the fact that that 39.6 rate goes into effect for people making $450,000 or more as a married couple. So if you made an even $500,000 before, you were in that 35% tax bracket. Now you're in the 39.6, but only for that amount of income over that 450,000.
It's a graduated table.
Right. So those people that make 500,000 a year are still being taxed only 10% on that first 20,000 or whatever the bracket. But then there's limits. Now, talk about these phase outs. There's certain income thresholds that you get to, and then you can't take deductions or.
Right.
Okay.
Right. What happened with the with the itemized deductions for higher income taxpayers? It used to be when you hit a certain income level, your itemized deductions would be reduced by 3% of the dollar amount over whatever the annual amount was that they had set in place. So it would gradually phase out your standard or your itemized deductions. And the same thing with the personal exemptions. They made some changes a couple years ago where those limitations were taken away. So all taxpayers got the benefit of the full itemized deductions and your full personal exemptions. And they are bringing in those phase outs again, but they are bringing them in at a higher level than they used to be.
Okay. So, and the higher level we're talking about is 250,000 for single folks and 300,000 for joint filers. And let's just stick, we've talked a lot about married couples and joint filers, so between the marriage penalty and so forth. Let's just stick with that. If you make 350,000, then you're not going to be qualifying for that top tax bracket at 39.6. You're still going to be at 35%, but for a certain amount of income over that 300,000, then you will have a deduction of about 3% of whatever your deductions would be. And those are anything on a Schedule A, like mortgage.
It's just off the top
interest.
that you calculate your Schedule A, and then it just comes off.
So if you make 100,000 over 300, 3% would be 3,000, and so if your itemized deductions totaled 43,000, instead now it's going to be 40,000. All right. I understand how that works. Okay. Then how about business taxes? Let's talk about that. Business tax legislation. And because, frankly, there was a lot of debate when how this was going to harm small businesses. And then there was the retort to that was, well, not many small businesses are paying their principal $450,000 a year. So how are they going to be affected outside of the individual income tax rates?
Well, the depreciation changes have been left in place for a few years with the 50% bonus depreciation and then the amount allowable for 179 deductions, which, then again, how much new equipment are small businesses purchasing to take advantage of these deductions. So, that's still something maybe more related to a larger business because they're really being aggressive deducting $500,000 in new equipment purchases, whereas a small business might spend $5,000.
Right. When people talk about small business, it's like, what's your definition of small business, right?
Yeah.
But still, for the business person who may have a business where they're making substantial investments, this is one of the favorable aspects of the Act that would extend and try to encourage those businesses to continue to make the investment upgrade in their equipment.
Right. It not only encourages them to take a deduction, it's encouraging them to buy, to go out and help the economy at the same time. So that was really kind of the main focus. The bonus depreciation and the larger 179 deductions were all put into place after 9/11 as a way to encourage businesses to start upgrading their equipment and really spending more money to try to help boost the economy.
Okay, so that's something that would have expired at the end of 2012. It was extended but not made permanent.
Right.
Okay, and rather than getting into a lot of detail, just briefly touch on the rest of the business ones, mentioning the
Sure.
research credit and so forth.
Right, yes, they extended and modified the research credit. Not a lot of small businesses take advantage of that. There are a few, but it's a very complicated credit to calculate. They have some credits for low-income housing. If you're building a apartment building that's not subsidized by federal funds, then you would qualify for a higher amount for a credit on that. A big one that most small employers around here have been taking advantage of is the work opportunity tax credit. If you hired somebody who was unemployed and you kept them on for a year, you received a $1,000 credit. Well, they've extended that again, so hopefully, I haven't seen the calculations, but I'm assuming it's still going to be about the same thing. So you know, that's a pass-through credit also. So if you have an S corp with employees, so maybe a slightly larger company that, you know, like a manufacturing company making $3 million a year, for example, that could pass through then to the owner to take advantage of those credits on their personal tax return.
And again, this is not something that you have to apply to the government for and show a bunch of proof. You can take this credit, but you just better have the documentation to show that you hired a previously unemployed
Right. There
person.
were required documents that the employee had to sign. It was a form saying, yes, I am certifying that I was unemployed and you've hired me. And when you fill out the credit form, you actually need to list the employee name, social security number, and then how much you paid them.
Okay, interesting. Well, I think that's still a good one. We have
Right.
relatively high unemployment still, and hopefully we can address that. Any others that you think are worth mentioning for our viewers here on the business side?
Well, the enhanced charitable deduction for food inventory is a nice one. I don't know if there would be a lot of businesses around here, but maybe restaurants or grocery stores that donate excess inventory to a food shelf, they get a little enhanced charitable deduction there. The other nice one that I do have several clients in the area that would be affected by the built-in gains tax. If you started out with a C Corp, you elected an S Corp status, the built-in gain tax only lasts for 5 years, and then it goes away versus going out for 10 years. If you say when you convert, you have a piece of equipment that you sell, and your tax then at a different rate based on what the basis was when you converted from a C Corp to an S Corp. And so that's what that is really referring to, is built-in gain tax.
Okay. Finally, is there any other changes taking effect in 2013? I see an increase in the standard mileage deduction by a whole penny.
Yeah, it's up to 56.5 cents per mile.
Right. I noticed, I mean, obviously that's changed quite a bit in the last 10 years as gas has gone from under $2 a gallon to at points it was close to slightly over $4 a gallon. Mm-hmm. But this is something that the federal government tries to look at the whole previous year and take averages and what the cost of operating a car is.
Right, and the mileage rate is a built-up rate. It's not just the cost for fuel. There's a portion of that that's the depreciation on the vehicle. So as prices of buying a new vehicle increase, that's also part of the calculation.
Okay. Medical expense deduction?
Yes, that's a new, not nice change where if you itemize on Schedule A for medical expenses, it's always limited, has been, to 7.5% of your adjusted gross income. Now what they're doing is they're limiting it to 10%. They've raised the bar. So you have to have more
than 10% of your
more
adjusted
than 10%,
gross income.
right.
If your adjusted gross income is $100,000, then you need more than $10,000 in medical expense, and only that amount, over that amount,
right,
will be able to be deducted.
Right.
Unless you're over 65.
Unless you're over 65, then it stays at the 7.5%.
Okay.
Yeah.
And here's one that I was shocked to find out, but the Flex plan, our Flex savings plan, I've tried every end of December, try to figure out how much are we going to spend on medical bills and so forth, and out-of-pocket deductibles and so forth, and co-pays, and then come up with an amount. Now they've drastically reduced it. It was, I think, $4,500 before. Now it's down to $2,500 for a family. regardless of the size of the family.
Right, yes, those are limits that need to be written into all of the flex plan documents for the businesses, where it used to be discretionary, and it still is somewhat discretionary for a company setting up a flex plan. They could make the limit $2,000, but they can't go over $2,500 now.
Okay.
That's the new cap.
401k contributions went up
Right.
to 17.5, and then 23,000 for those of us born before 1964, right?
Right.
Now, a question: can you continue to contribute to a 401k if you're over 70 years old?
As long as you have wages. You have to have wages.
And so, if you have wages and you were a Walmart greeter and made $8,000, you could contribute all of that $8,000 if you wanted. All right. What about why would you transfer your 401k money directly into a plan's Roth account?
Well, a lot of taxpayers want to diversify their retirement funds. So by keeping everything in a taxable fund, that when you retire, any dollar you want to spend, you have to take it out and pay tax on it. By converting it to a Roth account, it will grow tax-free, and then when you want to take a distribution, you don't pay tax on it at that time either. So it's nice to have the flexibility when you retire, to have some in a taxable and a non-taxable account, to give you the options for, if you say you wanted to keep your income below the 15% bracket, so you could strategically take out up to that amount from your taxable 401k plan and then take the rest out of your Roth account.
Okay.
And the Roth 401k is new. Not a lot of employers have those set up, but as they set them up, they're allowing you to do a direct 401k to Roth 401k transfer with your employer.
So that's what it's regarding. Because IRAs, I think they came into being in the 70s, and we had a $2,000 max contribution for a married couple, and then that gradually.
Well, it was per person.
Per person.
Right.
It gradually grew. Well, it was the same for a long time.
Yeah.
But then they created Roth IRAs in the 90s, and those could earn interest and earn the income on that investment tax-free.
Right.
And so that when you withdraw from it, you don't have to pay tax on a Roth.
Right. But you pay tax on the money when it goes in there.
Right.
So it's not pre-tax dollars going into the Roth.
Whereas a traditional 401k is pre-tax dollars going in, and then you get taxed on what you take out.
Right.
And so now this is where you can, now they have Roth 401ks, if you will. Okay. Social Security benefits were increased 1.7%. That's part of this American Taxpayer Relief
And it
Act.
was a smaller percentage increase than last year.
All right. And IRA limits, again, were raised to $5,500. That's per person. So when we said they were originally $2,000, they've a little more than doubled anyway. But if you were born before 1963, again, I'm in that group, then $6,500 can be contributed to an IRA.
You get the $1,000 catch-up provision is what they call it.
But there are income limits on those IRAs.
Right.
Contributions, whereas a 401k does not have income limits generally. Okay.
Yeah.
And we mentioned the 3.8% Medicare surtax on the investment incomes. And then also another one for the higher income earners, those people, married couples over 250, have a 0.9%, basically 1% Medicare surtax. Is that correct?
Right. That's a new surtax, which was also brought in by the Health Care Act.
So it's not really part of the Taxpayer Relief Act, but it's a byproduct
This was coming into play already at the beginning of the year.
Affordable Care Act, I guess is what it was called from 2 years ago.
And this is only for the taxpayer, not for the employer.
Okay. Finally, we get to the last subject, and that is with two certainties, death and taxes. We had for a 10-year period this estate tax show where almost like a game show where what's the limit going to be this year, and people had to consult with an attorney or an accountant. If I die this year, how much of my estate will be taxed? The amount went up and then it fell down, way down. Now, what is it at for 2013?
The exemption amount is $5,250,000 federally.
Okay, so for federal tax purposes, if you have an estate that's even $1 less than $5.25 million, there won't be any tax if that is all inherited by
Right.
your children.
Right.
But if you make over that 5.25, let's say you make 5.5 million, so you have 250,000, that's over that amount. That will get taxed at what rate?
40%.
Okay, so basically 100,000 then would go to the federal government of that 250,000. And so this is why you need to consult with estate planning attorneys to be able to account for that. Now, is this 5.25 million amount for 2013? What's going to happen for 2014?
I'm not sure,
All right.
to be honest.
It could go up or it could go down.
Right.
All right.
Right.
Well,
yes.
with that, hopefully we have some more certainty at least through 2013, and want to thank you for all your time in explaining this. Thanks for coming on the show.
You're welcome.
And
Thank you for having me.
the next time that maybe it could come in the next 2 months, but more likely next year when some of these changes are going to expire, we'll see more legislation and need to have you on again.
Right.
All right.
Thank you.
Sonia. And thank you, viewers, for watching us, and hopefully you learned something. And if you have any questions, you can certainly contact your tax preparer, accountant, or maybe even you folks at Clifton Larson Allen. What's your phone number there?
715-386-2391.
Or they can Google Clifton Larson Allen in Hudson, Wisconsin, right?
Correct.
All right, very good. Thank you, Sonia. And thank you for joining us on Western Wisconsin Journal.